Hi guys. Um, this week has been very interesting election week, the past week, and the markets have been volatile. The week before, they went down a little, 5 to 10%. But in my case, like I invest in tankers, they went down a lot, like 30% or so the week before. This one also, the airlines got also hit quite heavily the week before. Like for example, Safe Spirit Airlines, I think it dropped to about 15 or so, from 18 till 15, um, and that was the week before. And I had come into a tight spot because I wanted the week before to buy more airlines as they dropped, but I couldn't. My margin was maxed out, to my surprise. Uh, and why is that? Well, if you look at my brokerage account, I am long tankers. I'm long Corona stocks, which is airlines and cruise lines now. But before I also had the restaurants in like Shake Shack and Wien Resorts. Uh, and tech, I used to have Zillow, but also ArcG. But if you look at what's my long exposure with my brokerage, okay, that's 25% of my portfolio tankers, 37% Corona stocks, and 13% tech. If you add all that up, I'm 75% long with my broker. And uh, the question is how much equity or what's the net asset value? How much am I on margin? I'll leave it for a little bit later. But what else did I do? Actually, part of these stocks I've bought with proceeds from short sales of gold, especially. So I've also shorted gold past month, a quite big position, and received cash from that I've also reinvested mainly in these, because before I was investing in tanks, but after, once I started shorting gold, I started investing Corona stocks also. Um, and I also have cash, most of it also with my broker. So actually, but yeah, that's not a long exposure cash. A long exposure is stocks. So if you add these three, you get 75% long exposure. But of course, part of your own equity is not only the stocks, it's also the cash. But I'm 75% long in my portfolio, and then short. I'm shorting also there minus 37%, and also started shorting bonds recently, the past week, as indeed during. It's very strange what happened the past week, but we had a strong recovery in stocks, while at the same time interest rates collapsed again, and we went to for a TLT bond fund, long-term government bond fund with an average duration of 20 years. It went up because interest rates collapsed, and it went up to 160, almost 363. So I did my first short at 160 a couple of weeks ago, and that was my first minus 4% exposure. And then this week it went to 162, and I had my second short position there, another minus 4% or so. So that was minus is about minus 7% exposure. I have to shorting bonds now plus shorting gold gives a total short exposure of minus 44%. And so with my broker, I'm 75% long and minus 44% short. But both of these positions are exposures to the market. And so that if you add these two up, you get a total exposure of, I should do minus here, 120%. But my broker will look at, okay, and what's your equity in with my broker? And it's almost all of the cash, but not all. Let's say it's about 15%. It's basically around the equity with my broker is about 50% of my net asset value. So I have 50% equity, but I have an exposure of 120%. So I have a leverage of about 2.2, 2.2 or so, which is the maximum that I can get from my broker, the maximum initial margin that I can get. Of course, the maintenance margin is a little bit lower, huh? And so I'm not getting margin calls yet, but I can't buy any more assets anymore. And I also cannot short anything more, huh? Because if you add to the shorting position, you add to your total exposure. Huh? So that accounts in to both ways. And this is a problem because if the markets collapse, I really want to short more bonds. Like if the market's indeed correct, if we would test the Corona bottom, or even if you would go halfway, I would lose a lot on my tankers. Like I have that scenario set out here, and like let's say that happens. Okay, tankers have gone down a lot, but I do believe like the more they go down, the less likely it is that they continue to go down. And actually, with the Corona testing of the bottom, if we get other shutdown scenario, or even like one that's like only half as bad, and that's been starting now in Europe, they started locking down countries again. So if they do something similar as half a year ago, but just a little less worse, which is what's happening now, then actually tankers may pump because, well, that's what they did during the previous Corona crash also. Huh? Let's go, for example, to Sting here, which is Scorpio tankers. And let's look at the past year at the valuation. And so what happened was that you have, of course, yeah, they were going down while the stock market was going up. Huh? But then when you had actually the March month where the actual stock market collapsed, they didn't collapse much more. No, and actually they went up the month after, huh? because um, uh, because well, suddenly shipping rates went up a lot because there was a lot of oil not consumed and needed to be stored on the oil tankers, and so there was a high demand for storage and a low availability, and so shipping rates went up a lot, not to ship it but to store it, and so all these tankers pumped. For example, here's thing went from $15 to $25. So that's why what I've been doing is I've okay. So that's why actually I put -10, but actually it may also go up with 10% if we get actually an actual correction again in the stock market, another testing of the Corona bottom, another panic. Actually, tankers may not go down but up. Huh? But like, you have to always estimate modestly. Let's put it at 0. Short gold, yeah, gold will go down during a Corona crash as it did last time, but after it will pump a lot. But during the crash, it will go down. What will go down the most? Well, um, well, Corona shares, of course, airlines, cruise lines, they will get another big hit because, well, there is no hope for them. If we get another shutdown of countries, of course, they will get punished severely. They are already in very bad water, and to extend this Corona crisis is just very bad news for them. Crypto, as we saw half a year ago during the Corona crash, also gets punished heavily because it's a higher, it's perceived in the market as a high risk investment, such as also art or supercars, and they collapse very hard during a deflationary collapse. Tech stocks will likely collapse a little bit less, even though they went up the most, but they are perceived as the most secure investment during this kind of crisis because while they digitize a lot of things, for example, Zillow, yeah, people are very active also during the Corona crisis, buying and selling houses, and they do it more and more digitally. And for example, Zillow offers like 3D tours in houses, and you can buy and sell your house with one click without doing any visits, real estate visits. Or so that's of course in demand and will correct less. So this is my like as a scenario what would happen. Of course, short bonds would not go down; they would go up, and they would actually go test the all-time high that they did, and for that they would have to go up not 5 but 6, but no 7%, no 8%. The all-time high was 172 for the TLT fund. So this is what would happen with my portfolio, huh? And what would that mean? It means that I'm getting some serious problems because um, uh, the biggest problem is the short gold. Well, the problem is many of my investments go down in value, and so especially this one, which is a big exposure, and as a consequence, because the short gold, yes, it would go down a little bit, but not as much as the other ones. Instead of having a minus 37% exposure, it would become minus 50%. Um, and um, and of course the short bonds also, because I have a short exposure. If it goes up in value, this fund, I'm losing money. So instead of minus 7%, even without shorting anything more in bonds, it will go up to minus 12%. So my short position would really become a lot bigger. Paste. And oh, that's not correct. Let me do this. Now we get margin calls, and that's of course a problem because my stocks at the same time would have crashed a lot. Um, Joy, can you be quiet? I'm recording a video. Um, of course, I'm not talking about a scenario where we don't get a collapse and things go up, because I will do very well then. I have an exposure. Like if I wouldn't use, if I would not be shorting gold and shorting bonds, I would be like 46% crypto, and the rest would be, I would have about a 50% exposure to stocks. But thanks to shorting gold and shorting bonds, my exposure to stocks is not 50%, it is 75%. So I'm long more on the market than the equity I have. So if markets continue to go up, which I think is the most likely actually, especially as of today, there's lots of fear in the market. We already saw the second shutdowns of countries, that's already priced in. We already have priced in very much uncertainty and doubt about the US election, where while the Democrats are trying to steal it, there is clear indication that they've been that they put in false votes. If you look at the statistics, Trump is winning, and then the Democrats are winning less, and then suddenly you have a bump where they go higher as Trump, his votes were counted. So this will drag on probably a couple of weeks, and likely will reveal some. It looks like Trump has put in a big sting operation, because he knew beforehand he would do that, and probably has. What I heard as of this morning is that they've put a big sting operation marking many ballots, and then tracking what happened to them, and it looks like a lot of frauds will be arrested, and charged with frauding or falsifying or cheating on the elections. So it is going to be quite volatile, but but we are already in a period with lots of fear and doubt. So I think that it's most likely actually that whether Joe Biden wins the election or Trump wins the election, for the markets, both of them are okay, because the markets care much more about stability than about who's ruling. Who's ruling does not make that much of an impact on the markets than nobody ruling, or rulers fighting with each other about who's going to rule. That's a big issue for the markets. That's a lot of uncertainty. That's where we are today. That can cause civil war, and that's a total disaster for all portfolios. So that's where we are today, and that's, I think, well, not fully priced in, but we are certainly in such a stage of uncertainty. Also with the corona hoax is really like getting another big pump, another big fear injection by many countries shutting down again. So we have already that scenario. So I think it's much more likely that things will settle down, and it will become clear who will rule for the next 4 years in the US, and the motivation for many countries and many leaders to shut down their economy again is not, it's not, has nothing to do with corona. It's politically, It's politically driven. They want to hope to have the Democrats win. Huh? It's the Democrats that fully profit from the worse this corona crisis, the better it is for them. So I think that even if the Democrats win, the corona crisis will go down a lot because, well, once they won, they don't need to create more false flag attacks and more panic and fear because they got what they wanted. So I think that it's much more likely that markets will go up. And at the same time, the fear assets such as gold will go down. Huh? So I think this portfolio is very likely actually to do very well because my longs will go up, and that means my shorts will go down. Huh? And that means gold, yes, will go down in value over time as the fear fades away out of the market because now many investors are buying gold, but that likely will go down again off when the corona crisis lessens and the US elections settle. But when it comes to bonds with at historical low interest rates, very likely as the corona crisis flies by, interest rates will go up again to just the average of the past few years, which would mean that this fund drops to about 140 instead of 160. So that I would also make money on this short. Huh? So I think that's much more likely with this portfolio to happen. While at the same time, I think crypto is not does not have the same pattern as the stock market. I do believe it's most likely, stocks will continue to go up on a wall of worry, while crypto, who is not going up on a wall of worry, it's euphoria again in the crypto markets as Bitcoin has gone up from to about $16,000 past week. There's just euphoria in the market, and people are predicting much higher prices within 2 weeks. That all-time high will be broken, and that's not likely. If you saw my other videos on crypto, it's much more likely that crypto will go sideways and test and set higher lows over the next year, but not break the all-time high. That's only for in 2 years or so. So in the meantime, stocks, crypto will see some corrections over next year, while basically stocks continue to go up, and so that will allow me to use this cash. The cash I cannot use right now with my broker, but I can also not withdraw it because my equity would go down. So it's a bit stuck now, and I don't like it. But if this plays out, then my stocks will go up in value, and so I'll build more equity in my brokerage account. My shorts will go down in value, will also add more equity to my account, and I will be able to withdraw this cash and use it to buy more crypto when it corrects. That's the most likely scenario that I hope plays out. But another scenario is that indeed we do get a serious correction here, and then I'm in trouble. And the way I will solve this is by borrowing against my crypto. That's what I'm working on now, because otherwise I will get margin calls and get kicked out of my positions. So I need to bring more equity to my broker account, and because I will lose equity, not with the tankers, but with the Corona stocks and the tech stocks, I will lose equity. Wait, I did this wrong. Yeah, and I will have to bring equity not to my account. So that's what I'm working on now, and I think is a very good strategy to borrow against crypto. Of course, not too much. I don't want to get the chance to get liquidated, see my crypto being liquidated, but like in this scenario, of course, yeah, I can't do it too much because when the total market's correct here, crypto will also correct strong. So I cannot. I have to make sure I don't get margin calls even if this scenario happens. So how much can I borrow against my crypto? Maybe 20%, 25%, but I can't borrow 50% against my crypto. But I can do 20, 25%. That's unlikely to lead to margin calls, even if crypto corrects considerably. And that equity I can bring to my broker, and then I'll be protected in this scenario. So that's the plan, guys. I think my portfolio looks also much more clean. I did make some small mistakes actually the past week because, yeah, I want to buy more airlines. And then let me show that profile. Um, mm, yeah. So can I go to this? Um, so when I discovered that I would get margin calls a week ago or so, if the markets continue to correct, what I did, and the market had just corrected, and I had just lost 20% on my stocks. Um, yeah, the fear got the better part of me, and I made a mistake. What I did was I sold my restaurant check Queen and also my RG fund, and of course, and that raised my cash from 10 to 20%, actually to from 10 to 25%. But I also bought for 5% tankers, because yeah, I wanted to prepare myself for a stronger correction, a corona correction of testing the bottom where tankers might actually go up. So it's good I buy some more of that. And also valuations just crazy, as I shared also on Twitter, of some of these companies. So, but at the same time, I let go of about 15% stock exposure and to these restaurants and resorts and Archifa. It was the wrong time to do that, and I should have known. I should have known, like, okay, this is the right strategy, but wait for a rebound. I didn't. And as a consequence, what happened the week after now, like these stocks went up 10%, um, and tankers actually went down, continued to go sideways and down, like just there's no end to tankers dropping. And so, yeah, a big it's not a big mistake. Like I did it consciously also because I have to prepare for the worst case scenario. It's more important to avoid serious losses than to make some extra profit. And so, but of course, if you're disciplined, you should always like, yeah, not sell when it just went down and not buy when it just went up, because it will, even if it's like there will be chances to do that. I didn't have that discipline. I paid the price for it. And even worse, like after I did this operation, I came to the conclusion that I had not even increased my margin. Like I did not even have more margin. Because what happened was that many of these stocks actually they don't have high margin requirements, like about 30% or 20%. But then some of these tankers I bought have like 100% margin requirement. So so even though I went down, I lowered my stock exposure by about 10%, and I like I still had not created room in my portfolio. So that was also like I should have studied this beforehand, of course, but I didn't, and I only discovered now that some of these tankers you get 0% margin. Like they want to have, you should put like it will count 100% equity, which is a good sign actually of a market bottom. When your broker doesn't want to give you any margin for a certain kind of stock, it means they consider it as very high risk, and usually that's because it went down a lot. And it's just that, like it's not that they do fundamental analysis on the balance sheet or anything, or on the revenues. No, huh? Oh, look who's here. It's Martine. Huh? And so usually that's a sign that you're buying something of great value when your broker doesn't want to give any margin. But at the same time, of course, I would have made a lot more waiting for a rebound in these stocks, and only selling then. So yeah, only a week difference makes a lot of difference. But in the long term, I did clean up my portfolio correct. In that, yeah, it's important. Like I should have waited for a rebound, but still, I'm happy that I cleaned up my portfolio a bit. These Corona stocks were that list became too long. These restaurants are not such fast growers as these budget airlines, and so and have less potential to really capture a big piece of the market because there's so much competition. and less regulation in the restaurant and resort business. So it's much harder to make a buck there than it is with airlines, because yeah, there are not so many great budget airlines that are really capturing a lot of the market share today as airlines get destroyed. Huh? And there are many inefficient airlines still, big airlines. So, so I'm happy I cleaned that up. And also tech, of course. Yes, I should have waited for a rebound, but I'm happy I got let go of ArcG because it is not my field of expertise at all. It doesn't have to be because it's a managed fund, but strong hands is important. You need to have strong hands. And for me, yeah, I mean, this genomic revolution fund, it sounds super interesting and has great potential, of course, but there are so many biotech stories in the past that went nowhere. And it may not be the right time for that to invest in it. I don't know. I have no clue because I don't know the industry. I don't have a view on how revolutionary recent technological breakthroughs are there. So um, yeah, in order to make money in the world of investing, you need to invest in things that you really understand and believe in, because you will get hard times, and you will need strong hands. And I have that much more with a company like Zillow. Huh? And Zillow, by the way, wow, the past week it went down to $90, and I did load the boat around 95, and it's already back up in 1 week to a new all-time high of 100, almost $20. So a very strong performance there. I'm very happy that I joined this for 10% of my portfolio. This is the kind of stock that I feel like, as an investor, you often read about, if you just would have bought this stock and kept it for 10, 20 years and never sold anything from it, that's all you needed. All your other investments may go to zero. If you just did that, and there are many stock examples for that, like Google, Amazon, Microsoft early days, Apple, like there's so many stocks that if you would have done that, you would have done very well. But it takes a few decades to see that play out, usually, and great discipline never to sell any of it. And I think that's the case with a stock like Zillow. A very high probability that this company will grow from the current 30-40 billion to a mega company that's worth what's worth Microsoft today, or IBM, or Apple, or Amazon. I think Zillow has a similar potential because well, it's the real estate market. And if you have a monopoly in the real estate market, that's worth a lot of money, huh? Because real estate has great margins. Huh? You're not selling ads there. Huh? You take 5% or 3% of the value of a house with every transaction. So that's the potential of Zillow, and network effects play a very big role there. Once you are in the markets, if you have the network effect, like eBay showed, for example, like if you have the most buyers and the most sellers, it's the most competitive market, and it attracts others, and it's very hard to compete with that. Huh? So that's really what Zillow already has today. You don't even have to speculate. People that buy and sell real estate in America use Zillow. That's it. 200 million visitors per month. The same amount of visitors that Facebook has in America, Zillow has. Huh? So Zillow is as popular a website with Americans than Facebook is. That's crazy. Huh? But it's not cashing in on it yet. Huh? Because very few people that use Zillow actually buy and sell a house from Zillow. Huh? But that's where the big money lays. And that's the kind of business that also started the past few years, with one click buying and selling a house from Zillow, and to Zillow, is I think really the future here. Um, yeah. So also an interesting thing that I noticed is that um, the famous guy from the absolutely wonderful movie about the 2008 crisis. Let me look it up. Yeah, the wonderful movie, The Big Short, about the 2008 crisis. There you have also playing in that movie Stephen Carroll, an amazing actor, has made me laugh a lot with the Office series 10 years ago that I really loved. The Office US, not UK, US, and really a wonderful actor. But he plays in The Big Short the role of Steve Eisman. Steve Eisman, who's a real fund manager, and who did a great trade during the financial crisis. He was really short banks and short these mortgages, and made a lot of money with that. He's played by Steve Eisman, but Steve Carroll, but he's also like this guy is still active today. Steve Eisman is very interesting to follow his calls. But for example, if you followed my Tesla trade at the time, I also brought up Steve Eisman because he was short Tesla. He really believed it was a crappy, a shitty company. And I couldn't believe it because he has a great track record. But he believed that. And he was short Tesla, even around $200, $300 when it's still very cheap Tesla. And he was really wrong. And I believe that he was really wrong in his analysis. And yeah, he proved to be wrong also because it went up tenfold since then in just 1 year. But as of today, I researched Zillow. Same story, same story. Mr. Steve Eisman is short Zillow. Actually, maybe not anymore, but he's very bearish on the new business model of Zillow, where they start to buy and sell houses for their own account. He's very bearish on that. He believes that Zillow has no clue of the kind of crap that they're gonna buy for too high of a market price, and they're going to be stuck with it when there is a general real estate market correction, and they're going to lose lots of money on it. That's his opinion. But um, like the way Zillow has structured that is actually that, yeah, they buy and sell the houses, but they actually don't even own them. There's a separate structure that actually owns a house, and they have deals with banks where actually the banks are owning them. What they do is basically take just it's a margin business. They don't take the risk of owning these assets, but they do make 5% or so on every transaction. I don't know how much it is, but of course you're going to make good margin on buying and selling directly from the customer house, because the way they buy it is below market, considerably below market. You can sell your house to Zillow with one click, but it's 10% below the market that you could get yourself. But if you want to get it yourself, you have to put it up for sale on Zillow or somewhere else, usually on Zillow. And then you have to, if you don't want to do it yourself, hire a real estate broker, and have visits to your house and make your house look good, and deal with all these potential buyers, and pay the real estate broker a fee of also 5% or so. And you could just sell 10% below the market and be done with it with a click. And that's really, I think, genius. Uh, uh, um, but of course, if you would offer that service as a new company, you're not going to find any customers. But a company like Zillow, who already has total market dominance in the market and has trust with buyers and sellers, because people use Zillow. Why? Because it's such a great website gives you an idea what's the value of your house, because it gives so much information about houses in your neighborhood that has been sold or rented. It shows a history of the past 10, 20 years, for what price they were sold or rented over time. And so Zillow actually has the best knowledge about real, true valuations and how they are fluctuating in different areas. And so it's positions as the best to give you actually a price that is competitive, while they also still make money on it. So I really disagree with his opinion here, and it's interesting that it is very similar to the Tesla story here. But I do believe Zillow has gone up. Like, if you study Zillow, it's not like Tesla. Tesla was beaten down and really misrepresented in the media, and totally undervalued. I don't believe that's the case with Zillow here. If you look at Zillow, let's log, yeah. Yeah, the revenues are nicely growing of Zillow revenues. Let's take quarterly, not annual. A little dip here during the Corona crisis, but That's gonna go up a lot. Continues to go up. Revenues do very, very well and grow fast. If you look at, let's say, 10 years, we're now 2020, but let's look at the past 5 years since it started quoting. It did an IPO here. That would be then 2015, 170 million in one quarter. That was the last one. 700 in one quarter. 1.1 billion. And so 170, 1.1 is almost a tenfold in revenues in 5 years. That's very, very good. That's very, very strong growth. But then the question is, what's the potential here? And the potential is a lot higher. These kind of revenues can continue to tenfold and can even hundredfold over the next 10 years, 20 years, because of the huge market they play in and the already dominant position and monopoly position they already have in it. So if you look at valuation of a company, it was 5 billion 5 years ago, and now it's 30 billion. So it did also go up considerably. But for the most part, okay, up here a little bit. Okay, they were already at 10 billion here, and they were in 2017, they were still at 10 billion recently during the Corona collapse. But of course, now they are at 30 billion. So it's gone up a lot. And that's why I think that, no, it's not a steal to buy. But of course, if you have a cash problem, as Warren Buffett says, it's better to buy a great company at a good price than to buy a good company at a great price. And that does apply here, I believe. So I think it's still a good investment for the long term. And the art of an investment like this is to just hodl it for a decade. And I hope I can do that too. So yeah, Martine is such a good girl, and no complaining. If she's sitting on the lap, she's happy. She's not crying. Only when she needs milk or she's bored, or her diaper is full. And Martine, and this is my beautiful daughter that I have with Tabby, and she's only 3-4 months old or so. Martine? Yes, yes, So yeah, that's my strategy here, and let me know if you think I'm overlooking something. But I think that if I get can borrow against my crypto, then I'll be protected for the worst case scenario. And otherwise, if it doesn't happen and we continue to go up, I hope that my backup plan of using this cash for crypto will work out. And if that doesn't work out, because people ask me, crypto went up a lot, do you still think it will go from the current 450 billion to 200 billion? Yes, my probabilities are still the same, but that's always been 55%. That's not a high probability. It has the highest chance to go to that price, but it's 55 for a reason. That means it's 45, it won't reach that. And that's for good reason, because it's crypto. And you can't predict with much certainty the future or prices of an asset that's valued relatively low compared to other markets. And so I always recommend to have at least a 30% exposure around those valuations, even higher exposure when we went a lot deeper. I recommended 60% exposure and did so myself too when we went into the Corona crash. But as prices went up and people ask me, so how much do you recommend? Well, as prices go up, I recommend allocation goes down following the Kelly criterion. So it's been around 30%. And if you did that, you're fine. You won't miss out. Because a low allocation is something that is a big hit, will very quickly become a big allocation in your portfolio if you don't sell anything. And that's also been always my recommendation. You can't sell any crypto. You can only buy on corrections, but you can't sell it off. And yeah, if indeed it doesn't happen and crypto goes into a new bull market here soon, if that does pan out, which I think it's not a high probability, but it's possible, then well, yeah, I mean, I'll be okay. This 46% will become 80% really quickly. But Yeah. So those are the investment strategies. I hope you enjoyed the video. Thanks so much for watching. And I wish you all a great day. Bye.